Well, a very good morning for those in the Americas, a good afternoon for those in Africa and Europe, and possibly good evening for those in Asia. And welcome to this seminar. This is a seminar from the Private Sector Development Research Network, a community of institutions with an active research agenda on private sector development. My name is Matt Robinson. My day job is head of private capital mobilization at British International Investment, which is the UK's Development Finance Institute. And it's my job to moderate the session today. Today, we're going to hear about some really interesting cutting edge research from the Overseas Development Institute into what's holding back the flow of investment into emerging and developing markets from institutional investors. And the authors of the research, Samantha Attridge, Bianca Getzel, and Neil Gregory from the ODI are going to present their findings in a second. I think as moderator, I have just two jobs, and the first is to read out the housekeeping notices. So please note that this is a recorded session, and by participating, you're giving your consent to be recorded. If you could stay on mute during the presentations from our ODI colleagues, that would be appreciated to keep noise at a minimum. And during the presentations, please do post questions in the Q&A box on the Zoom software. And after the presentations, we should have good time for Q&A, and I will select some of them to pose to the presenters. And we may also have some time to gather more during the Q&A session itself. So that's the housekeeping over with. And then secondly, I think my job is just to set the scene a little to this research. And I suspect that everyone, or most everyone on this call, will already appreciate the critical task of connecting global capital pools to the financing needs in emerging and developing economies if the SDGs are to be met. But I wanted to add a kind of practitioner view to this because it's my day job to try and take some of the investment assets in emerging markets that my company, British International Investment, finds and connect them to investors who may want to share some exposure to that. And we do that because we want to scale our impact even beyond what's possible with our own resources, i.e. mobilization. But to do that, we've got to understand what the investors want. And I think there's two kind of historical issues we face, which this paper really helps us unpick. First, it's been all too easy to view institutional investors as a kind of homogenous lump. And I think as this paper really well shows for European investors, at least, they're very, very different. So first, pension funds are very different from insurers. Even within pension funds across Europe, they're very different from one country to another. And that's largely true of insurers too, albeit those in the EU still have some commonalities in terms of the constraints they face. But that dissecting of what's different in the constraints that investors face is very, very helpful to people like me. Secondly, I think the paper is really good at moving us from kind of hypotheses about what those constraints are to being very precise about the individual things that people like me need to work out how to unblock. So, for example, the macroprudential regulations often are kind of cited for holding back investors, but I think this paper shows that's actually less of a constraint for pension funds than it is for insurers. Costs, I think this paper illustrates, are very, very important. Costs of accessing emerging market assets are very, very salient for everyone, but particularly for sort of defined contribution pension funds. And then for a lot of investors, the kind of lack of data and misperceptions around investment performance is another critical barrier. So it does have a very real world application, this research, and I think that's what's so exciting about it and how people like me will use it. So with my thanks for the research to date, I will now hand over to Samantha, Bianca, and Neil to take you through the findings and then move on to Q&A. Over to you.
Thank you very much, Matt, for moderating and also your remarks highlighting the value of the paper. We want our research to be useful, so we're very, very happy to hear that. And also to extend our thanks to the PSDRN for enabling and facilitating the webinar today. So we've got quite a lot to cover, so I'm going to whip through things. So, I mean, there's no doubt now more than ever, we really need to accelerate our efforts to mobilize commercial capital, institutional capital in emerging markets and developing economies. So why have we done this? There's this huge expectation, as we know, born in 2015, maybe sometimes encapsulated in the notion of billions to trillions, but progress has been slow here. And, in the study, we note that private capital mobilization by MDBs and DFIs stood at about 71 billion in 2022, which is relatively unchanged from 2016. So we haven't seen, huge progress in this agenda. But yet, the discourse and the discussions kind of repeat themselves about the importance of this, and the recent kind of MDB reform agenda discussions and G20 discussions continue to place significant, if not more, emphasis on the agenda. So, we need to get to grapple with this. What was really important for us is that actually, kind of that expectation that was born in 2015, we're in a completely different environment now than we were in 2015. So we have the end of cheap money. So now we're in an area of high inflation and higher interest rates. This will impact, if you like, the relative attractiveness of EM, DM, DE assets versus advanced economies. We also see huge changes in the regulations within Europe. For example, regulation to address climate change. And in the UK, we've exited the European Union, so we've had Brexit. And finally, there have been some structural changes to pension fund markets themselves, which have implications as well for the ability to mobilize. So all of this needs to be kind of understood. And, as you said, Matt, we tend to talk about this from a 50,000 foot level, and we talk about it as if all these investors are a homogeneous blob. And that's not the case. So we thought there's a need for a more granular understanding and a need to revisit this agenda in light of these changes and understand what does this mean for our ability to mobilize. And we looked at that through three lenses in the paper, which we're going to briefly illustrate and talk to. One is the changes in stakeholder expectations and what that means. The second, what we categorize as kind of financial conditions. And the third is on regulation. So I'm going to hand over to Bianca.
Hi, everyone. So as Sam correctly outlined, the context that we began with starts from this kind of very 50,000 foot view of markets on a whole. Insurance and pension hold around 25 trillion if we think of the entirety of the European market. And then if we breaking that down, I seem to have cut off. Hopefully you can hear me now.
Bianca,
Yes, we can hear you.
we can hear you, yeah. You did cut off for a second, but you're back.
Okay, thank you. So yeah, back to where we were, 25 trillion in European market assets. And then we started breaking that down to try and estimate how big a contribution can we really expect European institutional investors to make towards emerging markets and developing economies. And in order to do that, we decided to look at the biggest countries holding capital within Europe. And there are 5 specifically, which we looked at: the United Kingdom, France, Germany, Netherlands, and Switzerland, that hold 17 trillion out of the 25 trillion in Europe. That's over 3/4 of the European market. However, what became very clear very quickly, going back to that granularity point, is that not all asset owners are the same, and thus not all asset owners have the capacity to invest in emerging markets and developing economies. That means that, in other words, the addressable market for mobilizing capital is much smaller than is often assumed. With that preface, we were still able to identify 35 insurance companies and pension funds that were the biggest across Europe within those markets that hold over 1/4 of that entire European pot. And then what we tried to do is go through their annual reports, go through Bloomberg data, any financial statements available to us to try and understand what is the current state. How much are they allocating today to emerging markets and developing economies? And we found that only 4% of assets held by these 35 institutional investors are in emerging markets. That's equal to just $250 billion, which is far off and very distant from the initial number that we started with. And what was very interesting within the research that's in the report is that we break it down for each of these investors. So each of the 35 you'll be able to see on the report. When we average the numbers of all of them, we see that pension funds allocate on average 9%, and insurance companies allocate on average 2% to equate to that 250 billion or $250 billion stock. But when you look at the report, you'll quickly realize that there are some investors allocating much more than that, double this average even. And then the question became, what would happen if all the group of 35 investors allocated in line with those top performers? And when we tried to run those numbers, we realized it would double. The emerging market allocation would go from 250 billion to 500 billion in stock. And even though that level of ambition we considered realistic, because it's not actually trying to change any hard obstacles, we already see investors allocating towards that higher percentage line, it is impossible to change a stock of assets in just a year. So we tried to estimate what flows over what time period would be needed to feed into emerging markets in order to double the stock within 5 years. And what you're seeing here is exactly that question. So we start from a 40 billion in flows, which is the current state, and we start adding more and more flows to emerging markets, increasing by 20% year on year. For comparison, that is the same level of growth we've seen in private markets or in liquid assets within Europe over the past 5 years. So with that assumption, by year 5, 120 billion in annual investment flows would be going towards emerging markets and developing economies to support a stock of 500 billion. I'm happy to go through the detail of how we got to this number even further in questions if that's of curiosity. But what we also very quickly understood when looking into the detail of these stock and flow allocations was that there's a lot of caveats to this 120 billion number, which is exactly comparable to the World Bank commitments in 2023, to give you a sense of scale. And what we saw is that not only is it far from transformational in meeting financing needs, hence the title of the report, it's billions, it's not trillions, but more so, it is very concentrated in investment-grade, publicly listed assets in big middle-income countries. And that's what you're seeing here on the right-hand side. 10 countries make up over 90% of the UK's EM allocation. And moreover, as we'll discuss later in the presentation, it's unlikely to materialize if key pinch points are not addressed. So before we get into those pinch points and start charting a path forward, we wanted to cover, as Sam discussed early on, what has changed since 2015. And I'll just briefly give a synopsis of the financial market reality and conditions. So when we traditionally spoke to investors and think of the EMDE opportunity, these 4 pillars resonated most clearly. One is the diversification potential that emerging market assets and currencies provide. The second is reputation, especially when you're thinking of current and future generations and how these asset owners appeal to them. That sustainability question is one that can be really buttressed easily by emerging markets and developing economies. And moreover, there's that risk return. And I think that was very clearly seen for a long time, especially since Addis Ababa and right after it in 2015 with that search for yield conversation. And then the cherry on that cake is long-run performance of these assets. However, it is no surprise to no one that the situation has changed drastically. What was between 2008 and 2021 changed very starkly in 2022 when risk-free interest rates swapped in developed markets, which led to significantly higher returns in safer, more familiar asset classes. And you're seeing that very reality of the MSI EM index in comparison to the US dollar movements on the right-hand side. So that search for yield narrative became much harder for institutional investors to justify. But if we zoom in on one aspect, one that resonates regardless of the shifts that we've seen in the short term over the past couple of years, and just look at long-run performance, we see a much more positive picture. EMDEs have provided positive, long-term, risk-adjusted excess returns relative to developed markets, especially when we look both at bond and equity. Over the bond period since 2008, emerging market bonds have outperformed developed markets. On the right-hand side, you see that when we take that long-run perspective, emerging market equities match US performance and outperform other developed markets. So that long-run conversation becomes extremely, extremely important here. There is, however, lack of data, of course, on the performance of EMDE assets, and Neil will speak to this, especially within the private asset space, which has led to that risk reception gap. But that doesn't take away to the fact that these numbers clearly evidence an opportunity in emerging market investment. But as Matt, I think, suggested at the very beginning in his introduction, these do come at a cost. There is a premium to investing in emerging markets, and we delve into that in the report. But even when we take that cost into account, these large economies of scale benefiting institutional investors, which we look at in the report, do have the potential to seize this opportunity, considering the financial market conditions and how they've changed as well. I'll turn to Sam.
Thank you, Bianca. And so now the second big change we need to be mindful of when trying to understand the potential of this agenda is actually the structure of pension markets themselves and systems. And essentially, many countries have a three-tier provision. One is at the state level, which is a pay-as-you-go system. The second is usually occupational schemes. And in there, we have something called a defined benefit scheme. And we also have defined contribution schemes. I'll explain a bit about the difference between those. And then we have individual kind of plans. So our study really focuses on this second tier, the occupational schemes, and looking at defined benefit and defined contribution schemes. So defined benefit schemes essentially mean that an employee pays into a scheme and there's a guaranteed retirement benefit at some kind of percentage of your salary. So these could be also known as final salary schemes. And so at some point when you come to retire what your pension is going to be worth. This is in contrast to what's known as a defined contribution scheme, where the individual pays into a fund, as does the employer, but the value of the pension is unknown. It depends on what that fund is worth at the date of retirement and the annuity, for example, that you can purchase. And I'll come to why this is important in the moment. As you can see kind of on the left-hand side, pension markets are undergoing reform. So basically, longer life expectancies are putting pressure on pension systems to make sure that they are affordable, but also equitable between generations. We also have seen a very low interest rate environment from around 2009 to 2022, which has depressed returns in these defined benefit schemes, which has made them very expensive. And so many of these schemes have been closed down. And pension markets are being reformed to shift from a defined benefit provision to a defined contribution scheme. So you can see here at the moment, France is the largest market with a defined contribution provision, and the Netherlands and the UK have big defined benefit schemes, but they are undergoing reform. And it is estimated, for example, by 2030 in the UK, that defined contribution scheme assets will far exceed that of defined benefit. So we're going to see this shift. So why is this important for, if you like, what we're trying to do here? So basically, as defined benefit schemes wind down, they need, remember that the retirement benefit is fixed, it's known. So we need, or pension funds will need very clear, stable, predictable cash flows to be able to meet those pension payments. And so essentially what would happen is that they will be shifting out of any overseas investment towards domestic fixed income securities. They will also be shifting away from equities because they need to match the asset with the liability. So that's that downward area. There's going to be a downward pressure, if you like, or a disincentive to invest in EMDs caused by that. However, there's a good news story, which is probably going to outweigh this. And that is that defined contribution schemes, particularly with younger generations who are at earlier stages in their life, will be pursuing what's called kind of growth strategies, which are pursuing kind of growth and return, especially in the earlier years. And so we can expect an increasing interest in EMD assets with a search, if you like, for return. However, and I think Matt and Bianca mentioned this, DC schemes are very cost sensitive, and we know that the cost of origination and the cost of investing in EMDs is expensive relative to advanced markets for various reasons, which we discuss in the report. Also, defined contribution schemes have a need for liquidity. They have daily pricing, for example. You can move your pension around. It needs to be priced when you transfer it out. And so there's a big opportunity here, but there'll be some structural issues which will need to be overcome in terms of, you know, the emphasis on low cost and liquid vehicles. Another positive story here is DC schemes can afford, the investment risk is with the individual, it's not with the employer or the pension fund. And so the individual can often, and they can be afforded choice in where they invest, which is something that defined benefit schemes don't offer. And as the younger generations or people become more aware, if you like, and engage in this kind of agenda, they can express their preferences and sustainability preferences as to where their money gets invested. I think it's over to Neil.
Neil, you're muted if you're speaking.
Thanks, Sam. So the other important change in context in financial markets in the last 10 years has been the increased attention to environmental, social, and governance issues. And there are two dimensions to this. The first, materiality, as it's called, is what are the environmental, social, and governance risks which bear on the potential financial return of the asset. And in this dimension, most pension funds and insurance companies have now integrated ESG risk assessment as part of their overall risk framework. So that's fairly mainstream, but this is not particularly favorable for EMDE investing because it's often more difficult to get information about the ESG risks in these markets. Sometimes these markets are seen as, and the companies to be invested in within these markets are sometimes seen as posing higher ESG risks than developed markets. So the increased risk screening for ESG risks actually is an additional risk factor which is taken into account in considering investing in EMDE assets. The other dimension to this, what we call the second materiality, is the growing attention to the impact that investments have on the environment and on social outcomes. And here, the framework is both the Paris climate change goals and the sustainable development goals. And so we do see more pension funds in particular paying attention to the impact of their investments, particularly the climate impact. And we do see more interest in allocating at least a small proportion of assets for impact. There's still some lack of clarity in some areas about the extent to which pension funds as fiduciaries for the pension assets are able to take impact into account in making their investment decisions. But increasingly across the European markets, there is an acceptance that so long as it doesn't negatively affect financial returns, it is consistent with fiduciary duty to take impact into account. And I think there's now general understanding that it is definitely part of your fiduciary duty to consider ESG risks if they could be material for financial performance. But the regulatory clarity varies between countries. You see on the slide, there's some differences between countries in the extent that pension funds are permitted to take ESG impact into account in their decisions. The big driver of changes in the way that these ESG issues are addressed by firms and by the investors in those firms has been coming from the EU and the Sustainable Finance Reporting Framework and Green Taxonomy that the EU has developed, and that increases the data requirements and again increases the challenge of investing in EMDEs where it may be harder to get that data. Back to Bianca, I think.
I think it's over to me now. So okay. we're going to look at what these kind of pinch points are and offer some observations on how these perhaps could be addressed. So we'll start with looking at pension funds. So in the EU, so that's France, Germany, and the Netherlands, essentially these are regulated by the EU Institutions for Occupational Retirement Provision Directive, and then those kind of directives are transposed into national law, and the UK and Switzerland has its own regulation. And essentially what we've seen is so you have 2 or 3 kinds of approaches to regulating pension funds. One, you have what's known as a kind of a principles-based approach, which is very high level principles, not particularly prescriptive. So they're about behavioral kind of norms. Then you can have an approach which is very rules-based, which will be very specific and specify many quantitative limits which would affect portfolio construction. Or you could have a combination of the 2. And that is what those first 2 columns in this chart show you. Now, all of them except Switzerland are predominantly regulated according to a principles-based approach. And mostly this is known as a prudent person principle. And essentially the impact of this, and we discuss what this is in the report, the impact of this effectively is that it would impose some form of natural ceiling on EMDE allocation. And the reason being is that it will limit the amount of investment in assets which are on unregulated markets and which aren't traded. So there's a natural ceiling here. But otherwise, countries or pension funds are free to decide how they want to allocate their portfolios according to their objectives. Some countries, as you can see, France, Germany and Switzerland also have a few additional, if you like, quantitative caps, which also may impact allocation. For example, maybe more formal requirements around the limits on what could be invested in unregulated or unlisted equities, for example, issues around forex exposure, some caps on alternative assets and international real estate. What you can see here is that Switzerland actually is the most conservative country that we looked at in terms of its pension fund, if you like, attitude towards EMDE countries. However, what we observed though is that even where there are caps, and as Bianca also mentioned, most pension funds are not nudging up against these kind of quantitative allocations where they exist. And indeed, we find examples, as Bianca explained in the modelling, of investors who are subject to the same regulation who are able to make much higher investment allocation. And so this leads us in our interviews to basically conclude that the issue is much more around behaviour, and especially in the Swiss market and especially in the United Kingdom. And in fact, in the UK, pension funds only allocate 0.5% of their pension, of their assets under management to EMDEs, which is extremely low, given Bianca said on average it was about 9%. And so, for example, what do we mean here by these behavioural kind of constraints? So in the UK, for example, pension fund trustees and asset managers are often reliant on advisors who provide very conservative advice about where to invest. So I think in the report we discussed that there's a higher burden of proof, if you like, for investing in EMDEs, given the limited kind of experience of many investors in this area. But also the fact that there are fewer liquid markets to invest in, but also the interpretations of fiduciary duty are squarely kind of focused on financial returns, and are a little bit unclear when it comes, if you like, to that second level materiality that Neil was speaking about. So what we basically say is that we need much clearer guidance, especially around impact investment and the if you like, the consistency with fiduciary duty and second materiality, ESG, but also much clearer direction from regulators and the government to enable pension funds to solicit, if you like, the sustainability preferences of the beneficiaries, especially with this shift to defined contribution schemes. So in the UK, for example, 90% of defined contribution scheme members allocate or tick the default investment option, which basically track kind of various indices with very low allocations to EMDEs. So we think, and I'll speak to this at the end, kind of, you know, there's quite a big broader action system agenda here. Bianca?
Thanks, Sam. So moving to insurance companies' regulatory pinch points, which are much more clearly defined than what Sam described in the pension landscape. The constraints are a bit harder on, or significantly harder rather, for insurance companies. And to illustrate that point, I'm going to focus on Solvency II in my remarks now. We also look at the Swiss Solvency test separately in the report. So the most, I think, well-known and discussed pinch point about Solvency II is the capital charges. And that's what you're seeing in the figure right in front of you here. EIOPA, which is the regulator, introduced lower capital charges for higher rated OECD or European infrastructure a while ago. But this favorable treatment was not translated to infrastructure in non-OECD or non-European countries, even though the data exhibits far superior credit performance, especially on LGDs for infrastructure in low and middle income countries. And we don't have a lot of data, but the data that we do have, which has been released from Moody's, for example, has been modeled, and what you're seeing here is from Risk Control, to show what the capital charge should actually be if correctly calibrated to the real level of risk throughout different high income emerging markets and middle income emerging markets by region. And I think this alone is very striking to think of, especially when we're talking about the private market. But that's the reality of this pinch point that gets so much airtime, is that it's not covering the entire landscape of emerging market asset allocation. On the contrary, what I found particularly striking is that this explanation doesn't tell me why insurance companies are allocating so little to more conventional fixed income or equities in emerging markets and developing economies. And the answer to that question lies in other aspects of Solvency II. The first one being the matching adjustment. The matching adjustment is a counter-cyclical aspect of Solvency II that is actually very beneficial to insurance companies. To be eligible for this counter-cyclical adjustment, assets must have fixed cash flows, which in principle means primarily bonds become eligible to the matching adjustment. And the reason it is so helpful is that during times of crisis, as credit spread widen, the assets decrease in valuation at a risk-free rate, and the matching adjustments allows insurers to discount that valuation. So that credit spread effect is not burdening them as much during that time. That is all very beneficial. However, the eligibility around the matching adjustment, as I just said, is limited to bond or bond-like cash flows. And in addition, only BBB or above assets, or i.e. investment grade assets, can apply to the matching adjustment. This means when we look at the credit rating data on any emerging market, really, the majority of them would not by default benefit to the matching adjustment. This creates a huge BBB cliff is what it's called within the regulatory terminology. And you're seeing that very evidently on the right-hand side. These are some of the insurers we looked at in our report, and we look at the risk appetite by credit rating, and you're seeing that BBB, that post-investment grade cliff, so starkly in where they're allocating. And so the matching adjustments gives us a bit of insight on that depressed allocation to emerging markets. But another reality that is also very stark is the risk margin. The risk margin ends up being effectively an additional reserve required by insurers to hold on top of their best estimate liabilities. And in very simple terms, it determines how much insurers have to hold in technical provisions, and in turn, how much they have available to invest in the real economy or in emerging markets or overseas. The problem with the risk margin is that it is extremely volatile. A small change in the interest rate ends up having a huge impact on the capital insurers need to hold back. And there are various different calibration exercises that have been done on the risk margin, showing that it is also too high. And what is positive, I guess, in this slightly more depressing pinch point story is that reforms are underway both at the EU level and have happened and are in the process at the UK level. So Solvency II has now transitioned and is transitioning to Solvency UK. And the biggest benefit of that is that the matching adjustment eligibility has widened within the UK context as a byproduct of that change in regulation. And on the risk margin side, it is actually being lowered in Solvency UK. Both of these are great developments. Solvency II on the EU side is currently in consultation process, and we hope to see a bit of that reflected. And I guess we'll have to tune in a couple of years here to see whether that graph I showed you ends up changing in regards to the BBB cliff over time as that hopefully alleviates. I think I'm turning to Neil here.
Thanks, Bianca. So, as we talked about earlier, the risk perceptions of emerging markets will be very important, and it can be important, therefore, that we increase the availability of data and insights into what the actual risk performance of those assets are. I think a number of MDBs have recently published more of the data that they assemble in the GEMS database, which is a good step forward, but there's still a lot further to go to actually communicate the actual EMD risk return performance of assets, because compared to developed markets, a lot more of the assets in EMDEs are private market assets, private debt and private equity, where you don't have the same transparency and availability of investment performance information. Let's skip on to the next slide, I think. So when we talk about solutions, just want to connect what we've presented today to the role of MDBs and development finance institutions. I mean, that's a subject for a whole other seminar, so I won't spend a lot of time on it today, but just to make the point that some of these challenges that we see for pension funds and insurance companies in increasing their exposure to EMD assets, there is a role for MDBs and DFIs in providing solutions to those challenges. Firstly, by originating assets which have higher ESG standards, meet the ESG and climate and impact reporting requirements, and have an attractive risk return profile. Secondly, because institutional investors need to invest in larger ticket sizes, assembling the assets that they originate into larger diversified asset pools and distribute them to investors. Thirdly, they may need to do some de-risking, especially to take away some of the currency and country risk, which pension funds and insurance companies are less willing to take. Often that can be done on commercial terms, but where it can't, there may be a role for blending in some concessional finance in order to bring the risk return profile to a point at which it meets the thresholds at which pension funds and insurance companies will invest. And finally, as we talked about, there's a knowledge and information role for MDBs and DFIs in sharing more data with investors on the financial performance, the ESG risks, and the impact performance of EMDE assets. Back to Sam.
Yeah, thank you. So, I mean, there's a lot of detail in the report. It's a 90-page report, so we can only kind of scratch the surface in this presentation, and we want to make sure we leave time for discussion. But just want to offer some final reflections that's really struck me, you know, when we were writing, you know, the conclusions and what does this all kind of mean. And I think the first thing that really struck us was, you know, this is a very complex endeavour. And that we just don't think it's going to happen kind of like overnight. As Bianca's outlined, we see a path to doubling the investment flows, and even, you know, over 5 years, it's a 20%. Even over 5 years, I think we're being quite ambitious, and we need to address these points. But I think, so the first thing, I guess we just need to be realistic and anchor our expectation is the first thing. Related to that then, and maybe I'm just speaking for myself, but I think the development finance community tends to dive quite quickly. We kind of operate, I think, a little bit in a silo, and we tend to kind of quite quickly dive into, if you like, what I call the intermediation issues, with a big focus, if you like, on the private side of things, given this challenge around the lack of public markets in some of these countries. But there are much wider issues around this agenda. For example, Neil's spoken about some potential tensions in the regulation with regard to climate change and ESG, for example, which are likely to potentially have negative impacts. So we need, if you like, to think about this in a much more joined up way and have some systems-based thinking on this. And I guess the other thing that really struck me when we're doing this, that, you know, when we were looking at the regulation and the structures of markets, I think it's quite difficult to disentangle this endeavour from, if you like, a domestic imperative, which is, if you like, concerned more with issues around financial stability. What do we think about the provision of social insurance? What's the role of the financial sector more broadly? And you see this in the different structures of markets within countries. So again, I think it's really important to kind of to think or to move to more kind of holistic systems-based thinking of this, and that if you like, the EMDE issue is a kind of a part of that, but you know, that's not what's driving. When we look at the changes in regulation, for example, in the UK, the changes to drive more longer term investment in UK infrastructure, the purpose hasn't been to drive investment in EMDEs, for example. So we need to be mindful of that. And so I think, again, thinking around the system, I think there are more philosophical issues about what kind of financial system do we want, what kind of world do we want to retire into, and what kind of world do we want our children to retire into. And I think these are quite difficult issues which require, as I say, kind of a broader range of stakeholders to engage and work together, including kind of, you know, departments for work and pensions, regulators, DFIs, MDBs, asset owners, trustees, etc., etc. So yeah, and then just a couple of issues we did came up, but we haven't explored, but need to be explored: the issue around FX and the issue of country risk. I'll stop there.
Well, thank you so much, Sam, Neil, and Bianca, for that great presentation. So I think we have about 15 minutes or so for questions and answers. Thanks to those who put some in the Q&A box. I think feel free, please, people listening, to add a few more. I think we possibly have time for a few more. I'm now going to just select a couple to put back to you, Neil, Sam, and Bianca. And I think the first one is just linking together a comment from Chris Clubb from Convergence and Valentina Ramirez from the I think it's the Institutional Investors for Climate Change Coalition. They're both sort of saying, what's the thing we should be asking pension fund regulators if we had a wish list? What's the top thing? And I think Valentina sort of builds on that to say, what's the role of industry bodies in sort of amplifying that ask and trying to sort of put their shoulder behind it. So maybe have a think about that one, and then I've got a couple more.
So I'll just jump in here and then others can add. So, I mean, I think the first thing, as I say, what we've observed is we didn't seem to think that regulation per se was the biggest constraint here. So, however, we did observe potential tensions in the regulation that's being developed with regard to sustainability, and at the EU level with the SFDR, I think, for example, the corporate due diligence, for example, regulation. So we would be very mindful and would advocate that, this regulation is developed in mind about the applicability, if you like, in developed markets versus emerging markets, and be very mindful that this isn't going to have a disincentive effect in terms of allocation. Also, I think a very live issue is around how regulation is viewing and treating transition. So if an investor is focused very much on the net zero footprint, if you like, of its portfolio, that could be acting as a disincentive, for example, to go to some markets which might have a higher carbon footprint. So I think this issue around regulation and being mindful, if you like, of any negative spillover effects is something that I would certainly highlight on the regulatory side of things. And then secondly, as I said, in a number of markets, much clearer guidance in terms of the consistency of fiduciary duty, especially with second materiality impact. I think it's fairly a given that the first materiality is there, but second materiality ESG impact. I don't know if others have any thoughts on the regulation side of things.
Well, thank you, Sam. So actually, if I summarize that, it's almost the wider sustainability and corporate governance side of things, as opposed to anything specific around pension fund regulation. If I could jump to a second question, then this is from Chris McHugh. I'm not sure where Chris is from. I think Chris's question is essentially around, well, it would obviously probably make sense for institutional investors dipping their toe in emerging markets to buy listed securities, but I think he's asking, does that actually generate any new primary flows into the assets that we care about? And that's actually a kind of common debate in impacting DFI investors. So what would be your response to that challenge?
Maybe let me pick that one up. I think two things on that. I mean, firstly, more of the investment opportunities in emerging markets tend to be in unlisted assets, so private debt and private equity. So particularly once you get beyond the biggest middle income countries that Bianca showed, that's where most of the EMD assets are today, because they're mostly illiquid assets. So you have these overlapping issues that partly these institutions have to get comfortable with taking more EMDE risk, but they also have to get comfortable with taking more liquidity risk of buying private unlisted assets. They have been doing that in developed markets. There's been a shift over time that they've increased that allocation to unlisted assets in developed markets. So they need to do the same and be prepared to take the risk on that. And to go with that, we need to find ways to give them more access to data and information about the performance of those unlisted assets as you have in developed markets. The second part of it, and again, this comes back to the role of MDBs and DFIs, is that we need local capital market development and to support for more emerging market firms to list and issue corporate bonds. So there are programs underway. The UK has a Mobilis program. The World Bank Group has the Joint Capital Markets program, which are doing that. So you need to increase the supply of liquid investable assets. And I think the most immediate opportunity is in corporate bonds, issuing green and social and sustainable and climate bonds. I think we are seeing more issuance of that from emerging markets, and we're seeing good uptake of that. So I think that's part of the solution.
Thank you, Neil. So maybe moving on to another theme, and actually you touched on it in your last response, Neil. Chris Club again has observed around the kind of limited number of EMDs that are investment grade. But actually, I mean, and then in your analysis, is it actually is it more surprising that there isn't more capital flowing to those 10% of EMs that are investment grade and that have listed market opportunities? Because the amount of capital flowing from these investors to those types of assets is still very, very low. And I'm wondering what's the constraint holding back that upper tier? Maybe it's in middle income countries, but it's certainly got listed and investment grade opportunities, and it's still very low. And that is that the kind of first tier of the challenge before you even get into the private non-investment grade, lower middle income type of sort of level. So that's a kind of version of Chris's observation that I've paraphrased.
If I can jump in here, Matt, and then maybe colleagues can add on. But I think that at least when you think about the slide, there were many graphs I showed you, but from the jump in ambition, when we tried to calculate, you know, if all of them allocated in line with the top performers, what would happen? The bigger jump is happening on the insurance side, not on the pension side, in regards to who's contributing to that change in the from 250 billion to 500 billion. And I think that speaks to exactly your point, that insurance companies are the ones that have these harder constraints on allocating through the matching adjustment, especially to fixed income in these countries. And I think that point that Chris made on country risk ends up being ubiquitous and kind of overlaid on top of the regulatory constraints in regard to the fact that there's this perception issue, right? Not only are they burdened by the regulation, not only are they burdened by credit rating agencies and the sovereign ratings that limit them and the country ceiling they're in, but they're also limited by this country risk perception issue. And I think all of these components together are what limit investments into these bigger countries. I will also say that our numbers were pulled from 2022 and 2023 after we saw a significant change in financial market conditions. So all of these things combined, I think, are what answer the question. But just one asterisk on the comment you made, Matt, of should this be the first plan of attack, you know, almost the lower hanging fruit. I think what we come out with, maybe colleagues disagree with me on this, but at the end of the day in our research, it's a bit too late to first do one and then the other, right? As Neil was suggesting, we have solutions that we can scale, especially on the MDB and DFI front, to make fiduciary and regulatorily compliant assets also on the private side, and we should seize that opportunity in full force.
Thanks, Bianca. Neil or Sam, did you want to add anything to that?
Something we haven't looked at but came up, so was also about the design of market indices and the weights, if you like, of EMDs. Well, certainly some EMs in those as a potential issue. I noticed, I think India is just about to be included in a I think the MS. There's a big. It was in the FT, I think, yesterday. Going to be included in one of these indices, and it's going to expect to see, you know, to drive capital there. So I think there's an issue also around the creation of market indices.
Mm-hmm. Thank you. So let me go to the first question actually that was posed anonymously, which relates, I think, to a key real or perceived issue around EMD investing, which is around the rate of return. And you put some very powerful sort of long-term graphics both on the debt and the equity side, showing how over 20 years plus the EMD compares very favorably, or at least as well as developed markets. But the question relates to, you know, what happened between 2012 and 2021, even on the debt side, particularly where the search for yield might suggest emerging markets would have been you know, preferable. That wasn't panned out in the data. So could you address that question?
Yeah, I can jump in here. I mean, I think that there's a lot of realities that play into this. First off, is that the data that we showed there was for MSI, meaning it's looking at 24 of the bigger EMs. So that also interplays with a lot of challenges that those EM had, especially post-financial crisis. But I think it speaks to, you know, in that latter half of the 20-year span, it's not that far off of developed markets excluding the US. And I think that's what we should also focus on here. And the point is that there's fluctuations. They will inevitably happen. They will happen even more on emerging markets, and bigger emerging markets are even more prone to large changes in financial conditions. And that's what the data, I think, was reflecting there. And there's, I'm happy to share it with the group, a great piece that did a more detailed analysis on all the different fluctuations throughout that period of EM performance. And I think helps also break it down and alleviate and tone down the conversation in regards to the performance question and how heightened that search for yield quest has become, I think, when we're talking about the mobilization potential. But maybe Neil and Sam have stuff to add.
Great, thanks, Bianca. And that extra research sounds very interesting. Right, maybe time for just a couple more. I guess building on your own comments, several people are starting to put observations and questions around the products and the roles that DFIs and MDBs can play in creating the products that are suitable for these investors. And Sam Bilal, for example, just asked what's stopping the scale up of things like the portfolio MCPP program, and also noting that funds like the ILX fund, which have attracted institutional investors, haven't needed any subsidy or concessional finance. And what are your insights into, I guess, the kind of relative solutions that MDBs and DFIs and partners in the asset management industry are already coming up, and which ones are most suitable?
So I'd make 2 points on this one, Matt. First, I think the finding from our research is that you need to offer low-cost, risk-diversified products at scale to make it easy for pension funds to put these EMD assets into their portfolio. There are some structures, I think MCCP that Sam mentioned is a good example that MDBs have developed, which do that. So there's definitely scope for replicating those structures. I have to say there's also still an awful lot of project finance and one-off blended finance structures and so on that are not scalable and replicable. And so I think the message of MDBs and DFIs has to be really to shift your focus from trying to do one-off innovative transactions to do plain vanilla cookie cutter, low cost stuff at scale that we know can attract pension funds and insurance companies. And the second observation, when you talk to the institutional investors, is many of them have very low awareness of what the products are that MDBs and DFIs can offer. Most of them have not worked with them. They've not had exposure to their products. They don't know about meager guarantees. They don't know about possibilities to de-risk. They don't know about funds like the ILX fund or the MCPP programs. I think there's also a communication and knowledge gap to be filled, and we hope that the kind of research that we've presented today helps MDBs and DFIs start to fill that knowledge gap by enabling them to start from where pension funds and insurance companies are today, as opposed to starting from where we wish they were. Thanks,
Neil. And just very briefly at the end, are you planning, and this builds on a question from I've lost the person, Starla Griffin. She said, are you going to do similar research for, I guess, other jurisdictions, US, Asia, and yes, what are you planning to build on this piece that just focused on 5 European countries in any way?
Yes, we have in our sights to expand the research. Certainly, we were thinking that our next would be looking at more progressive markets, for example, in the Nordics, about what we can learn, but also we're open to expanding the research to different jurisdictions.
Great, that's a nice note to finish. So there is more to come. I think with that, unfortunately, we're going to have to call it time. As ever, there are more interesting questions and observations coming in right at the end, which we don't have time to answer. But maybe just to conclude by thanking everyone for joining, thanking the Private Sector Development Research Network and the ODI for hosting, and most of all, thanking Neil, Sam, and Bianca for the really excellent research and the contributions today. And I'm sure this is not the, well, it's definitely not the end of the debate, but it's a very useful contribution to it. So finally, thanks from me, and I hope everyone has a very good weekend. Thanks very much.